Good morning, everybody. Welcome to the Reserve Bank and to our June monetary policy statement. The Reserve Bank this morning has decided to keep the official cash rate unchanged at 2.5%. The economic outlook remains weak in New Zealand and offshore as well. But we are now seeing some signs of international economies stabilising and also some signs of financial conditions improving internationally. Partly related to that, we do expect the New Zealand economy itself to start growing again towards the end of this year. But the recovery is likely to be slow and fragile, and we do warn that key economic indicators, for example unemployment, will continue to deteriorate through much of next year as well. We see in our forecast quite significant downside risks both to activity and to inflation. But for the first time in some months, we can actually also identify some upside risks to our forecast. For example, stronger net immigration and some signs of housing market activity do lead to possibility of a rebound in household consumption and residential investment. But we warn that such a marked rebound would probably not be sustainable due to the very soft outlook that we still have, the fact that employment, wages, farm income are still very soft, and also the fact that household debt still remains quite high. Overall, on balance, we still feel that the risks on our forecast are to the downside, not the upside. The recent strength in the New Zealand dollar, we feel, does provide something of an unhelpful tension with our forecasts. The extent to which the strong New Zealand dollar is happening at the same time as there is weak international world demand really has the potential to delay or even reverse the growth in exports that we would otherwise be forecasting, and to limit the strength of New Zealand recovery. Recent developments do point to lower inflationary pressure than in our previous forecasts. Our annual CPI inflation forecast now temporarily drops below 1% later this year, but we expect it to go back up early next year within zone and to remain comfortably within that target zone. Looking back over the year, we've cut the OCR by a very large amount, and we do expect to see further effects feeding through into the economy. Some of that will pass through to more borrowers over the next couple of quarters because a number of the fixed rate mortgages are up for repricing during that time. We're quite aware that long-term interest rate pressures have been also putting upward pressure on long-term lending rates here in New Zealand. But despite that, we feel that there is room for further reductions in short-term lending rates in the banks in New Zealand. The low OCR and the stimulatory fiscal policy that we've had over the last year and this year have been the main supports to keeping activity going in the economy. It is going to be some time before recovery is strong enough that monetary policy support would be able to be withdrawn. And for that reason, we feel it's appropriate still to keep substantial monetary policy stimulus in place. We state again that the OCR could still go modestly lower over coming quarters. And as we said in our April OCR decision, we do expect to keep the official cash rate at or below current levels until the latter part of 2010. Thank you very much, everybody. That's the formal part of the press conference. We're open to questions. To assist, I've got Tim Hampton, head of our forecasting team, and David Drage, head of financial markets intelligence in the bank. Do you have any questions for us?
Dr. Bollard, we're facing what is probably the biggest economic crisis since the 1930s. Why didn't you just take out a little bit more insurance and cut again and worry about the inflationary effects after, which are going to be far less than if we go further into the mire?
We considered whether or not we needed to cut further at this stage. We felt it was time to halt and assess the effects. We're not concerned about inflationary issues at the moment. We feel comfortably in zone. We feel that we're starting to get information that says that we're through the worst risks around financial instability. We've still got a pick-up to take place. The fact that we've been cutting rates so much over the last year means that there is a lot of stimulus there, which will be having an impact on New Zealand. So we're prepared. We feel we can watch it. But as I say, we still feel there's downside room for lending rates to come through on the OCR that's currently there.
Dr. Ballard, are you concerned that the banks aren't reacting in the way they should to your continued lowering of the OCR up until now?
Well, I mean, as you're aware, the picture is a complex one for banks. First of all, they've had a very difficult period as they've gone through and found over the last year that their long-term term funding internationally has no longer been assured. That's been a very difficult period for them. That's now looking better. We've got a number of the New Zealand banks that have successfully raised significant funds offshore. We think those funding pressures are easing. But at the same time, of course, long-term rates internationally have been pushing up for reasons nothing to do with New Zealand, but reasons related particularly to American funding requirements. And as that's happened, that's also put pressure on prices for banks. The banks are picking up a lot more in deposits now. We feel that's highly desirable from the point of view of New Zealand's rebalancing. But to do that, they're having to pay a lot. We do still feel that there's room for the banks to further reduce short-term rates. We cut rates in April by 50 basis points. We also went out on a bit of a limb and have put in place strong expectations that we're going to keep rates low for quite a while. We think that should offer them enough assurance about that to move further.
Are you considering any other action to help bring down short-term rates? I mean, you've been jawboning this issue for some time now. The banks don't seem to have responded in the way that you would have liked. Are there any other sort of tools that you can bring to bear?
Well, we have been talking about the need for banks to do that. We've been talking more directly to the banks, and indeed with the banks, they do need to. As I say, they've been through a very difficult time, but we now think that financial stability looks much more assured. We think that's the point at which the banks do need to weigh up their responsibilities to shareholders against their responsibility to the New Zealand economy. They do have a responsibility to the New Zealand economy to help our recovery, to help orthodox monetary policy to take its effect, and we're looking for that to happen. We do have further powers, but we don't believe they're really set up for this purpose, and they're not something we would look to in the short term. We note that the Select Committee of Parliament has done quite a hard-hitting report on this, and they may want to take that further. In addition, of course, New Zealanders can move accounts and borrowing around, and I'm sure that they're going to be looking at that as to where they can get better deals.
You described the strength of the dollar as unhelpful and unsustainable. Why don't you intervene in the market and sell some in these circumstances?
Primarily because we don't think that would have any effect for the sort of medium-term numbers that we're looking at.
Dr. Ballard, how much further do you think short-term lending rates should come down?
Well, we've always avoided putting actual numbers on that. We're not setting the retail rates. The banks are doing that. The last time that regulators tried to set those sort of rates was back in Muldoon's days, and we don't wish to go back there. So we declined to put a number on that, but we do say that we think there's room at the short end.
Sorry, just to follow up, I mean, are you talking a few basis points, or is it a significant move that you're expecting to see?
Well, we note that we did move the OCR down 50 basis points and make statements about the length of over which time it would stay down. That should have given the banks quite a bit of confidence about what they could do.
Dr. Ballard, what are the further powers that you have decided wouldn't really work in these circumstances? And is there a need for perhaps consideration of whether or not new powers might be added to your portfolio?
Well, the Reserve Bank has got significant powers for under the Reserve Bank Act, but most of them are envisaged in the context of financial instability, and I don't think we're seeing financial instability at the moment. Quite apart from those powers, we have a lot of cooperation when it comes to requesting information, and we may be looking for further information from the banks on this. But the powers are strong and rarely, or if ever used, types of powers that are there.
What specifically are they? I mean, can you explain? I mean, can you direct them to do things?
We can direct the banks for certain purposes if we believe that financial stability is at stake.
In terms of lowering the interest rate further, while it might not, you might decide on balance it wasn't worthwhile at this point. What about its effect on the exchange rate? I mean, several people have suggested that lowering the interest rate would have, even if it wasn't that effective on monetary policy, might have had an effect on the exchange rate.
Well, we don't actually think it would have had terribly much effect on the exchange rate. The exchange rate looks like it's pretty much being set by a dominant financial market issue, and that is the need to fund US government debt, which has been impacting on bond prices, but also the need for the US economy to rebalance, and that's one of the dominant things that's driving international exchange rate moves at the minute. You can look around the world at many other countries which have got upward pressure on their currencies at the moment. Some of them, like, for example, Canada, have very, very low, something like 0.5% interest rates. So it's not really a yield difference that's driving it this time. They're still getting upwards pressure on their currencies. In a situation like that, New Zealanders have got to get by as best they can, and they've got to be prepared for still volatility on those numbers.
One final question. In terms of at the short end, where you think that the banks do have room to move, could you explain what the sources of funding that the banks do have at that short end and what sort of rates they're paying?
Yeah, perhaps I could ask David Drage to answer that question.
Sure. Well, there's certainly differences and pressures that the banks are facing at the moment. Certainly we've seen some easing in wholesale market pressures in recent times, particularly in money markets, both here and globally. Balancing that is the significant upward pressure on deposit rates associated with the scramble for funding that's underway at present. That's been reflected both the pressures associated with increased corporate bond issuance that's been targeting a lot of that retail funding and has made the banks have to fight harder for it. But against that, the ongoing easing in global funding markets potentially creates an opportunity for the New Zealand banks to more fully use that as alternative source of funds, and it would be interesting to see going forward whether that takes some of the pressure off funding locally.
Sorry, just to explain what that means. Does that mean that there are sources of short-term funds at low interest rates that the banks could access?
Well, you really need to look at sources of funding generally rather than for particular terms. We've seen in global markets in recent months an increasing appetite amongst investors for bank debt, both government guaranteed and increasingly now also unguaranteed debt. The Australian banks in particular have made significant use of that demand, and potentially there's a good opportunity for the New Zealand banks as well.
And what sort of rates are they getting that money at, and especially the Australian banks, which are the same funds which are being lent into New Zealand? I mean, what are the margins there?
Well, that varies considerably. It's hard to put a particular number on it, but generally, both in terms of the primary issuance of that debt and in terms of secondary market trading, those margins have been narrowing considerably in recent months.
Well, you talk about, the statement talks about the possibility that the trend growth rate on the other side of this may turn out to be lower than we've been used to. Do you have any sense yet of how much lower? Or?
Well, all around the OECD, countries have been looking at preliminary re-estimates of trend growth, and it's pretty much generally accepted those are going to be lower. Tim, do you want to be more specific on that?
So over the next 2 or 3 years, trend growth in New Zealand is likely to be held down by the fact that business investment and the purchase of new capital is going to be very weak, and so that's going to be pulling trend growth down. That's likely to turn around, towards the end of the projection as confidence returns and the economy returns to sort of a more steady path. But in the meantime, we are projecting trend growth to be around 2% for the next 3 years or so, and that compares to numbers much closer to 3% previously. Now, what happens beyond that, it's likely to be higher than the 2%, but whether it returns to those 3% numbers, it'll be some time before we know that.
What sort of scale of benefit is coming through from the rollover from high former interest rates to low rates now, and how much do you think of that is likely to be spent or saved given rising unemployment?
Well, you can see in the publication the effective mortgage rates and how that has been coming off. That's actually been more helpful in New Zealand than it has in a number of countries. Countries like the United States have really struggled to get that number down. We've got more stimulus. I don't think we've actually calculated a number from that and its impact on consumption.
In terms of the amount of further declines, about another...
Possibly another percentage point or slightly more coming through over the next 12 months. We have around 35% of all mortgage debt outstanding comes up for repricing in the next 12 months, and that's coming off an average rate of just over 8%. So still significantly above what's currently available, particularly in terms of shorter-term mortgage rates at present.
Dr. Bullard, could you talk about what's happening in the housing market and what you think it means for the economy and how you might have changed your view on where that's going?
Well, we haven't changed our view much, but we have noted slightly higher housing sales than we had in the past. We're speculating a little bit to the extent to which that actually relates to vendors being a bit more realistic about lower prices and actually stuff going through the market a bit more. We believe there's probably a little more strength on residential investment than we might have thought, but we do note that building consents are still very low, and that should warn against any expectation of a significant upturn in that market. So in overall prices, we've seen nominal prices come off around 11%. We think there's a couple more percent still to go. In real terms, that relates to a peak to trough of around 20%. We had something like 25% in previous forecasts. So a little less fall away in the housing market still to come, but still some rebalancing ahead.
And how sustainable do you think this recovery is?
Well, if it's a result of vendors getting more realistic about prices and the market sort of opening up again, then that's probably sustainable. If people think that happy days are here again and it's time to get right back seriously into the housing market, then we're very clear we don't believe that is sustainable, partly because household debt is high, partly because the New Zealand economy needs to rebalance, and it needs to do that through building up export growth. And while the TWI is slowing the speed of doing that, our forecasts do expect that to happen. If it doesn't happen, we will see the markets at some stage softening the New Zealand dollar so that it does happen.
Internationally, long-term interest rates are rising quite fast, and again, overnight there was a poor Treasury bond auction. What do you think that rise in long-term interest rates globally and here in New Zealand, as we've seen with mortgage rates, do to any recovery?
Yeah, well, look, we have been through a very big period of turbulence, and when you do have those very big periods, you get a lot of uncertainty, and it's simply unclear how markets recover and how one should interpret some of these recovering market prices in the longer term. That was very much the lesson of the 1930s. There were false dawns, and it was very difficult to interpret some things. Now, this time, it looks like the recovery has shown up quite early in US and international financial markets. It's happened through equity price recovery. It's happening through bond rates, particularly long-term ones, going up. Partly the market's responding to these very big financing needs that are becoming apparent from US government debt that needs to be funded. And it's also coming about in a realignment of exchange rates, which we feel may be a temporary phenomenon with US dollar softer. How those impact through onto the macroeconomy, how much they help the US economy to recalibrate but make it more difficult for the rest of the world is still to be judged. If the latter is true, at some stage the markets are going to have to realign some of those prices so that we get a chance and better conditions to recover that external imbalance that we've got. On our forecast, it does improve, but it's very fragile.
Dr. Bollard, you've noted in the statement that the New Zealand's poor external position might at some stage pressure the New Zealand dollar downwards. I think the bank's said this quite a few times in the past. How do you expect that to happen, and over what period would you see it happening?
Well, as you're aware, we don't make a forecast on the exchange rate. We do a working projection because that's the only thing we can do. And we have our exchange rates coming off, going weaker fairly soon. But we also recognise that recent events suggest that there are some sources there's upward pressure on the exchange rate. So we therefore have a scenario that shows the exchange rate holding roughly where it is for some time longer, allowing a bit of a mini recovery, which then doesn't look sustainable. And when that unsustainability becomes clear to the markets, we believe that under that scenario, we have the exchange rate falling away. And you can see the sort of impact it has. Actually, we get stronger short-term recovery from it, but it doesn't look good medium-term. We pay for it in the medium term. So we're pretty clear from our point of view. We would rather see a recovery driven by softer New Zealand dollar showing through onto stronger exports and showing up in the current account balance. But we're not clear that that's necessarily going to happen. We all have to recognise a lot of uncertainty out there, especially if the markets are saying US needs to recover first, other countries get in line, which is what we may be seeing at the moment.
Dr. Bollard, you said after the last monetary policy statement there was a risk of a nasty inflation shock because of the money printing and very low interest rates globally. Do you still think that there is a risk of that?
Well, I can't remember my words exactly, Bernard, but I don't think I quite said that. But we have earlier been concerned about what inflation internationally might look like. The more recent forecast that we're seeing, both from large countries and the OECD and the IMF, suggest actually it's a couple of years away before one actually would see that. That doesn't mean it's a couple of years away, however, before some of those countries would need to tighten monetary policy in order to get in advance to do something about that. If you follow the speeches of Ben Bernanke, Chairman of the Federal Reserve, you'll see him pre-positioning around that. Actually, the markets believe that the Federal Reserve will tighten later this year.
You've warned in the past about the market pushing up long-term interest rates. Would you still look to warn them about that, and would you look at taking any action, perhaps bond buying, to force long-term interest rates down if you were still worried?
At the minute, we're focused on orthodox monetary policy. We think it's been working well for us, and that's where we're still focused. So while, as you might expect, we've looked at other options, there aren't simple other options there. All the quantitative easing, credit easing and other variants of those that have been looked at and sometimes used in the Northern Hemisphere, we don't think would be easy here, and we're not intending to use them as things stand at the moment. Thank you, ladies and gentlemen. If there's no further questions, that's the end of this press conference. Thanks for coming.